Hey everybody, welcome back. This is part 2 of my CAPM video. CAPM being the capital asset pricing model. If you did not already see the first video, please go back and watch this before watching this one, because that contains some great information on the formula itself for CAPM and how to put it together in a theoretical sense. But in this video, what I want to do is show you a practical application of the capital asset pricing model using Caterpillar, CAT, Caterpillar stock as an example. How I've laid out this Excel formula to show you that, or this Excel sheet to show you this, is I've taken the time span from October of 2013 to October of 2018. I found the 10-year Treasury note adjusted closes. These are the yields, and averaged those out. Found the S&P 500 adjusted closes over this 5-year time span and averaged out those returns, and then found the same thing for the stock that we want to use as an example, Caterpillar. So just a quick review of just the basic fundamental premise of CAPM is that you're using it to find the minimum required return that you would accept on a stock as an investor, taking into account the amount of risk that you're taking on. That is the most fundamental premise of CAPM. So if we look at the formula really quick here, like I said, the required return of the stock, that's what we're looking for in CAPM, RI equals the risk-free rate of return, that's right here, plus beta of the stock that we're looking at, which is going to be Caterpillar's beta, times the return on the market, which is why we have the S&P 500 index returns, so we'll be able to plug that in, minus again the risk-free rate of return. That's the CAPM formula. So let's take a look at this. First, risk-free rate of return. Let's plug that into our formula. So if we go down the bottom here, I have these highlighted. I found the average return over the 5-year time span for the 10-year Treasury yield, and it was 2.32%. So that 2.32% is what we are going to plug in right here, the risk-free rate of return, and right here. So if you want to write this out, you can write it out if you'd like. So that's the risk-free rate of return. The return on the market, or RM, is you basically find the monthly returns of the market over this 5-year time span, the market being the S&P 500. You annualize them, and you will find that if you would have just invested in the market over this 5-year time span, you would have gotten back on average 10.2% per year, which is a pretty good return. So we've been in a pretty long bull run, and the beta, just you don't really, well, I went over this in the last video. The beta of the market is 1. Like we said before, if you have a beta on a stock that's greater than 1, that means it moves with the market, but just at a higher magnitude. And if you have a beta less than 1, it still moves in the same general direction as the market, but it moves at a less magnitude. We'll call it that. So now that we have that's our 10.2%. That's going to go right here. Rate of return on the market, return on market index. So now we have the risk-free rate of return, risk-free rate of return over here, the return on the market, that was our 10.2%, and all we need is the beta of our stock that we're looking at as an example. So if we look at that, that's right here. You take the returns monthly and then annualize them. What you have is you've a return on an annual basis for Caterpillar of 15.56%, which is pretty good. And the beta is, you don't need to know this, but the beta is basically the slope. You would take the returns monthly of the stock, put them up against the returns of the market, and you would get the beta. So our beta is 1.49%, which makes a lot of sense, because if you look, beta return on the market was 1, so that's 10.2%, and this beta is almost 1.5%, and we had a return of 15.56%. So that actually made a lot of sense. It doesn't always work out that perfect, but it was pretty close here, so that's pretty good. So if we take our beta, 1.48%, we now have everything we need for our CAPM formula. So if you look, risk-free rate of return, 2.32%, plus beta, that 1.49%, times the return on the market, that was 10.2%, minus the risk-free rate of return, which was 2.32%. And if you do all that and you plug them in, you will get a required return. This is CAPM right here. You'll get a required return of 14.04%, which means that if you would have invested in Caterpillar over this time span of October 2013 to October of 2018, you as an investor should minimally require a return of 14.04% given the level of risk that you have taken on in investing in this stock. Now, that's your answer. And as a bonus, we can see that our actual average return over that time span was 15.56%. So because our actual return was greater than our required return, this was a really good investment. So if you would have invested in Caterpillar stock over that time span, that would have been a really good investment. So that is what the capital asset pricing model shows you. The minimum required return that as an investor you should accept for the level of risk that you take on. And that is the capital asset pricing model in a nutshell. Hope you guys enjoyed. Hope you got something out of it. And I will see you next time.